My dear students, welcome back to our channel. In this video, I will be explaining the MBA 4th semester subject Strategic Financial Management. As prescribed by JNTUH and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Tip to remember. TTDA-VPG types, theories, diversification, approaches, value, problems, guidelines. A simple mnemonic for key areas to revise before exams. Unit 5 first important short question is Types of mergers. A merger is when two companies combine to form a single company. There are 5 main types of mergers, each with a different goal and strategy. 1. Horizontal merger. Two companies in the same industry and level merge. Example, Airtel and Tata Teleservices. 2. Vertical merger. A company merges with a supplier or distributor. Example, a car company merging with a tire manufacturer. 3. Conglomerate merger. Companies in unrelated businesses merge. Example, ITC, FMCG, acquiring a travel or hotel business. 4. Market extension merger. Merging to enter new geographic markets. Example, a North India-based bank merging with a South India-based bank. 5. Product extension merger. Companies with related products merge. Example, a laptop company merging with a computer accessories brand. Easy to remember line. Highway Pro is equal to horizontal, vertical, conglomerate, market, product. Conclusion. Understanding types of mergers helps companies grow strategically, save costs, and reach more customers. Next important short question is 2. Value creation in mergers and acquisitions. Value creation in mergers and acquisitions, M&A, means that the combined company becomes more valuable than the two companies were separately. In simple words, 1 plus 1 equals 3 in a successful M&A. How is value created? 1. Synergy, cost savings or higher revenue due to better resources, shared technology, or bigger market share. 2. Economies of scale, larger companies can reduce per unit costs. 3. Increased market power, more control over pricing and competition. 4. Access to new markets products, faster business growth. Example. When Disney acquired Marvel, it gained access to superheroes and created blockbuster movies. Both brands grew stronger together. Easy to remember line. Synergy makes 1 plus 1 equals 3 in mergers. Conclusion. Value creation is the main goal of M&A. If done right, both companies benefit through growth, profits, and long-term success. Next important short question is 3 elements and importance of value-based management. Elements and importance of value-based management. Value-based management, VBM, means managing a company with the goal of increasing the value of the business for its shareholders. Main elements of VBM. 1. Value creation focus. All decisions aim to increase shareholder value. 2. Performance measurement. Tools like EVA, economic value added, and MVA, market value added, measure how well the company is creating value. 3. Corporate strategy alignment. Every department and employee works toward the same goal, value creation. Importance of VBM. Helps companies make smarter financial decisions. Improves long-term growth and sustainability. Builds trust with investors and shareholders. Links company goals with employee performance. Example. If a company invests only in projects that earn more than their cost of capital, it is using VBM. Easy to remember line. VBM is equal to value first, profit next. Conclusion. Value-based management helps businesses grow wisely and keeps everyone focused on the main goal, increasing company value for the long run. Next important short question is 4. Diversification and mergers and acquisitions. Diversification means a company enters new markets or industries to reduce risk and grow. Mergers and acquisitions, M&A, are powerful tools for diversification. How M&A helps in diversification? 1. Spreads risk. If one business fails, the other can support the company. 2. Quick entry. Instead of building a new business from scratch, companies acquire existing firms to enter new areas faster. 3. Increases growth. More products and markets mean more opportunities and customers. Example. Tata Group has diversified into steel, cars, hotels, and IT. When Tata acquired Jaguar Land Rover, it expanded into the global luxury car market. Why it matters? Diversification through M&A helps companies become stronger, safer, and more competitive in the long run. Easy to remember line. Don't put all eggs in one basket, diversify with M&A. Conclusion. Diversification through mergers and acquisitions is a smart strategy to grow fast, reduce risk, and build long-term business value. Next important short question is 5. Approaches to value-based management, Merco, Alcar, McKinsey, BCG. Value-based management, VBM, uses different approaches to measure and increase a company's value. 4 popular models are 1. Merco approach. Focuses on the gap between return on equity, ROE, and cost of equity. If ROE cost of equity value is created. 2. Alcar approach. Focuses on managing value drivers like sales growth, profit margins, and capital use. Example, improving profit margins increases value. 3. McKinsey approach. Links strategy, performance, and shareholder value. It breaks business into parts and improves each for better value. 4. BCG approach, Boston Consulting Group. Focuses on business units and uses tools like the BCG matrix, stars, cash cows, dogs, question marks, to allocate resources wisely. Easy to remember tip. M&A is equal to manage all models boldly. Conclusion. These approaches help companies make better decisions that directly increase shareholder value and long-term success. Next unit 5. Long questions. First important long question is 1. Mergers, acquisitions, and value-based management. 1. What are mergers and acquisitions? A merger is when two companies combine to form one new company. An acquisition is when one company buys and controls another company. Purpose, growth, cost saving, market expansion, gaining technology, or reducing competition. Example. When Flipkart was acquired by Walmart, it gave Walmart a strong presence in the Indian e-commerce market. 2. Why mergers and acquisitions happen? To grow faster than competitors. To enter new markets or launch new products. To reduce costs and share resources, called synergy. To increase market share or remove competition. 3. What is value-based management, VBM? VBM is a method where all company decisions are made with one goal, to increase value for shareholders. VBM focuses on creating value by investing in high-return projects, controlling costs, improving performance, using financial tools like EVA, economic value added, MVA, market value added. Link between M&A and VBM. Mergers and acquisitions are used as strategies to create value. If done correctly, the combined company becomes more valuable than the two were separately. Example: when Disney acquired Marvel, it added huge value by using Marvel's superheroes in movies, merchandise, and theme parks. Easy to remember line. Merge to grow, acquire to lead, manage to add value. Conclusion: mergers and acquisitions help companies grow strategically, and value-based management ensures this growth increases real worth for shareholders. Together, they are key tools in modern financial management and business success. Next important long question is: two theories of mergers. What are merger theories? Merger theories explain why companies merge and what they hope to achieve. Different theories give different reasons like growth, tax savings, risk reduction, or management control. 1. Synergy theory. This is the most common theory. It says that the combined company will perform better than two separate companies. Formula: 1 + 1 = 3, not 2. Example: when two telecom companies merge, they can reduce duplicate towers, save money, and offer better services. 2. Efficiency theory. Mergers improve operational efficiency, better production, skilled staff, and better use of resources. Example: a manufacturing company merges with a logistics company to improve delivery efficiency. 3. Monopoly market power theory. Companies merge to reduce competition and gain more control over pricing or market share. Example: big fish eats small fish to become king of the pond. 4. Diversification theory. Companies merge to spread risk by entering into new markets or industries. Example: Tata Group diversifying into hotels, IT, and steel. 5. Tax shield theory. If a company has losses that can be set off against profits of the other, mergers help in saving taxes. Example: a profit-making firm acquires a loss-making firm to reduce tax liabilities. 6. Agency theory. Sometimes managers merge companies not to create value, but to increase their own power or job security. This is seen as a bad merger. Easy to remember trick. S.E.M.D.T.A. S. Synergy. E. Efficiency. M. Market power. D. Diversification. T. Tax. A. Agency. Conclusion. Understanding merger theories helps companies make strategic and value-creating decisions. Not every merger is good, the reason behind it matters. Next important long question is: 3. Government guidelines for takeover. What is a takeover? A takeover happens when one company, called the acquirer, buys a large portion of another company's shares to gain control over it. In India, takeovers are regulated by SEBI, Securities and Exchange Board of India, under the SEBI, Substantial Acquisition of Shares and Takeovers, Regulations, 2011. Key guidelines for takeover, as per SEBI rules. 1. Trigger point 25% rule. If a company acquires 25% or more shares or voting rights of another company, it must make an open offer to the public shareholders. Example: if company A buys 25% of company B's shares, it must offer to buy at least 26% more from the public shareholders. 2. Open offer requirement. The acquirer must make an offer to existing shareholders so they have a fair chance to sell their shares at a specified price. 3. Offer price. The offer price must be fair and based on market value or past transaction price, whichever is higher. 4. Disclosure is mandatory. All takeover plans and deals must be clearly disclosed to SEBI, the stock exchange, and the target company. 5. Time limits. Open offers must be completed within a specific timeline, usually 60 to 90 days from the announcement. 6. Exemptions. Certain takeovers, like family restructures or intercompany transfers, may be exempted from open offer requirements. Easy to remember trick. 25. Open, price, disclose, time, exempt. 25% rule, open offer, fair price, disclosure, timely action exemptions. Conclusion. SEBI's takeover guidelines ensure that takeovers are fair, transparent, and protect public shareholders. These rules prevent sudden control changes and promote investor trust. Next important long question is 4. Problems on mergers and acquisitions and cases. Problems on mergers and acquisitions with easy steps. Problem example. Company A Limited is planning to merge with Company B Ltd. Number of shares A Limited is equal to 1 lakh. Market price per share A Limited is equal to 80 rupees. Earnings A Limited is equal to 8 lakhs rupees. Number of shares B Limited is equal to 50,000. Market price per share B Limited is equal to 40 rupees. Earnings B Limited is equal to 2 lakhs rupees. The merger ratio is 1 share of A Limited for every 2 shares of B Ltd. Now calculate 1. Earnings per share EPS after merger. 2. Whether merger is beneficial to A Limited shareholders. Step-by-step solution. Step 1. Calculate total earnings after merger. Earnings of A Limited is equal to 8 lakhs rupees. Earnings of B Limited is equal to 2 lakhs rupees. Total earnings is equal to 10 lakhs rupees. Step 2. Calculate number of new shares issued. Company A is giving 1 share for every 2 shares of B. So, B Limited has 50,000 shares. A Limited will issue is equal to 50,000 divided by 2 equals 25,000 new shares. Step 3. Total shares after merger. Original A Limited shares is equal to 1 lakh. New shares issued is equal to 25,000. Total is equal to 1,25,000 shares. Step 4. Calculate new EPS. EPS is equal to total earnings divided by total shares. EPS is equal to 10 lakhs rupees divided by 1,25,000 is equal to 8 rupees. Step 5. Compare pre- and post-merger EPS. Before merger, EPS of A Limited is equal to 8 rupees. After merger, EPS is equal to 8 rupees. So, no change, shareholders of A Limited are not affected negatively. Conclusion. In this case, the merger doesn't reduce A Limited's EPS, so it's neutral or slightly beneficial, especially if synergy or growth potential exists. Next important long question is 5. Value-based management meaning, approaches, and strategic importance. Meaning. Value-based management, VBM, is a way companies make decisions to increase their overall value, not just profits. It focuses on creating wealth for shareholders by managing all activities to maximize the company's worth. Simply put, VBM aligns business goals, strategies, and day-to-day operations with value creation. Example. Imagine a company that focuses only on increasing sales but ignores costs and cash flow. It might sell more but lose money. VBM helps the company focus on actions that truly increase its market value, like smart investments, cost control, and efficient use of resources. Approaches to value-based management. 1. Economic value added. EVA. This approach measures the value created after deducting the cost of capital. If a company's profit is more than what investors expect, it creates value. 2. Market value added. MVA. It shows the difference between a company's market value and the money invested by shareholders. A positive MVA means the company has increased shareholder wealth. 3. Cash value added. CVA focuses on actual cash generated from operations after covering capital costs. It helps understand if cash flows are generating real value. Other popular VBM models come from consulting firms like Merco, Alcar, McKinsey, and BCG. These use frameworks that combine financial metrics with strategic goals. Strategic importance. Helps companies focus on long-term growth rather than short-term profits. Encourages efficient resource allocation to projects that boost value. Improves decision-making by linking financial performance to value creation. Aligns interests of management and shareholders, reducing conflicts. Guides mergers, acquisitions, and restructuring to maximize value. In short, VBM is a smart financial strategy that helps Indian companies grow sustainably by focusing on what truly matters, creating lasting value for shareholders.